introduced. First of all, yes, I want to introduce Professor Elisabeth Curtis. We have nice cooperation for years with Professor Elisabeth, and she was working in Indian University, in Drexel University, in Dartmouth College. She is a specialist in monetary policy and also in economics of transition. And she is a member of Fed Council, Fed Challenge Council, and also was a jury in NBU Challenge, yes. And she was teaching many courses in macroeconomics, in international finance, monetary policy regarding Fed Challenge, Fed system. So you can ask different questions regarding monetary policy, and you are able to ask also some question about the US system. Yes, so we'll be very, very glad to see her today, and I'm very happy that she's helping us always. And as she mentioned, she's going even to volunteer in Moldova to help Ukrainian refugees in February. So we are thankful for this very much, and for all the support, and for studying Ukrainian language. Yes. So thank you a lot. Thank you a lot. And I hope all other students will be able to see the recording, and because we want everybody to study and to keep learning. Thank you a lot, Elisabeth.
So thank you, Natalia. I'm going to be a little shy and not practice Ukrainian. This isn't very live, but it's live to me today, maybe at the end. I have a little Ukrainian actually at the end, maybe. Thank you, Natalia, for the invitation to come speak to you and your class. It's a great honor for me. I teach now at Dartmouth College. So you see my Dartmouth logo on the top of the screen. Has anybody heard of Dartmouth College? You can put your hand anywhere you want in your in your screen, or you can use your Zoom hand if you'd like to. Does anybody know where Dartmouth College is? Have you heard of Dartmouth? Has anybody heard of Harvard College? Harvard University? Yeah, okay. So poor Dartmouth. So I will tell you a little bit about me quickly. I teach at Dartmouth College. Natalia mentioned to you that we compete, Dartmouth College, my team competes at the College Fed Challenge competition. So this is a competition about monetary policy in the United States. And you've all heard of Harvard University. Well, Dartmouth's Fed Challenge team beats Harvard. We've beaten Harvard 3 times in a row. So just to give you a sense, Dartmouth is also an Ivy League university. It's really a college, technically speaking, but it's in a similar category to Harvard University. So we're also a very good Ivy League school. We're in New Hampshire, so very far north. We don't have snow here yet, but it's coming, I think. I appreciate the invitation. It's lovely to be here. I do have a lot of slides. I don't need to share all of the slides with you. So if we have a conversation and you have questions as I'm going through the lecture, please feel free to interrupt me. If I say something you don't understand, or if I say something you want to know more about, you can stop me. You can raise your hand. Again, even in either your screen, or I suppose maybe the better place there, so I will see you, would be in the raise your Zoom hand and I can see you. Or you can also take your mic off and interrupt me. Say, Professor Curtis, I have a question. I would like this to be an opportunity for you to share your ideas, not just for me to talk at you. So I hope that we'll have a conversation with one another. So I just wanted to make sure you knew you could interrupt me, or you could raise your hand anytime. And I will share these slides with Natalia so that you can have access to them. This is not a technical discussion. I wanted to share with you some of the ways I teach when I'm teaching about monetary policy to my students that compete at the Fed Challenge competition. I also want to give you, I am going to compare systems, right? To look at the US central banking system and what our concerns are with monetary policy today, and also think a little bit about the Ukrainian circumstances. What does the National Bank of Ukraine need to think about today in this very challenging time, where one of the jobs of the National Bank of Ukraine is to help the economy stabilize in this very, very difficult time of war. So we'll do a comparison, and at the end, I will share with you some research that I didn't do, but that I learned about at a recent conference at the National Bank of Ukraine. So I was able to go to a conference in remotely that the National Bank of Ukraine held, and some really interesting brand new research being done. I think for your students, this might be interesting because this is information maybe for future thesis, for master's students or PhD students. There's lots of work still to be done in understanding monetary policy and inflation targeting. We'll talk about that. So how do you think, can I hear from a student or two with maybe a thumbs up? Am I speaking clearly and slow enough everyone can understand me?
Yes, I think.
Okay, perfect. I was telling Natalia that when I'm studying Ukrainian. I speak some Russian. I'm studying Ukrainian, and I realized that if people speak like I'm trying to speak to you, I understand a lot in Ukrainian, but most people don't speak like this. So I want to be understood, and I'm not in a hurry. So okay, so thank you for the invitation. Let's get started. All right, I'm not going to read all of this. This is just who I am. There's lots of information here, but you can see that I'm connected to Ukraine in a few ways. I also have a Polish connection that's more recent. My Ukrainian connection, the first time that I spent time in Ukraine, I actually lived in Kharkiv, and I was an instructor in economics, and this was way back in the 90s. So I'm telling you a little bit about how old I am here. But that's my most important contribution. Maybe one of the most important things that I've ever done in my life was to live in Ukraine in the 90s and as a teacher. And I made many good friends that I still have today. And I also had the great honor of teaching at Naukma in, I say it was 2021. I think it must have been. Was it just, maybe that's wrong. It might have been 2020.
2020, I think, yes.
2020. So my dates are wrong, but I taught a course remotely because this was COVID. I was supposed to come in person, and I was very sad I couldn't, because Kyiv is lovely in May and June. Those are very lovely months in your cities. And I imagine some of you are joining from who knows where. Do we have a really interesting place that somebody is joining us from? Are you willing to tell us? Anybody willing to say where you're coming from? Anything interesting worth saying? We're going to be shy. I had students when I was teaching in COVID. I had students that coming to my class from Georgia, from not the state of Georgia, but the country Georgia. I had a student coming from someplace in India, which they had very different time zones. So we're used to doing this for better or worse. So again, a little bit about me. You can ask me questions later on about experiences if you'd like to. Okay, so this is what we're going to do today. I'm going to tell you a little bit about the history of the Fed, the history of our central banking system, and a little bit about monetary, the role of monetary policy. Some of this, I'm sure, is review for you, but I'd like to put this in context for you as we do a comparison later. So most of what we'll talk about is discussing current macro conditions and the outlook, so the forecast for the US and Ukraine. That's what I'll spend most of my time on. And a little bit about the EU, sort of where they fit, but mostly it will be the US and Ukraine. And we will focus on inflation and inflation targeting, since that's what most central banks these days do. And it is a concern today. Inflation is a significant concern globally. Of course, inflation is always a concern in Ukraine and in other similar countries at the sort of the stage of economic development that Ukraine might be in. But in the United States, inflation to us is pretty new, especially to somebody who's 10 or 15 or 20 years younger than me. And I'm also going to highlight some research. I mentioned that to you before. So if you're not aware of current work that's being done, and much of this work is being done by Ukrainians. So I'm going to share some of this with you. All right. So first of all, here's the Board of Governors seal of, and everybody sees still my slides, okay?
Apologies, no, we can see, we still see is like the main screen.
Okay, so I knew I had a feeling I should ask that question. Let me stop sharing and go back. Sometimes this happens, and we've been using Zoom what seems like forever, and yet I'm not an expert. I am not an expert. So let me change. Let's try this. No, let's try this. Okay, can you tell me if I'm forwarding now?
Yeah, now it works fine.
Perfect. Okay, thank you. Great. Okay. Somebody in the room is smarter than me about this, and you'll say, this is the reason why it happens. But I don't know. I only know how to fix the problem. Okay, so here's a little bit about the creation of the Federal Reserve System. So in the US, prior to the creation of the national bank, we had state banks. We had individual states in the United States that had their own bank, and they had their own currency. So it was a little like Europe before the euro was created, if you can imagine, right? You've maybe studied a little bit about a currency union. And this was, so I was studying some of the research that was being done to before the euro was introduced. I studied research that was trying to understand the benefits of having a currency union. And so when the euro was first introduced, they did a lot of research, and they researched the experience of the United States. Because in the United States, we had a bank in Indiana, and they had a bank in Ohio, and a bank in Massachusetts. And these different banks, these different state banks, issued their own state currency for a period of time. So they didn't have a national currency. So the original reason for creating the Federal Reserve System was, first of all, to establish these regional banks, these Federal Reserve banks, that would have a centralized head. And the central head of the Federal Reserve System is called the Board of Governors, and that's in Washington, D.C. And the other reason to create the Fed was to furnish currency that was elastic, so readily available and controlled centrally, right? There's a few other things that the Fed was created, and you will hear me refer to the Federal Reserve System simply as the Fed. That is our shorthand notation, short word for the Federal Reserve System. The other kind of final important duty of the Federal Reserve System is to have a supervisor for the banking system. We know that I won't go into the importance of the banking system in an economy. We know how important the function of banks is as intermediaries, right? Facilitating those people who need funds with those people who have funds, kind of coordinating or matching and taking on risk at the same time to make sure that firms that need money at the time that they need money have it, right? So we understand how intermediaries work, but this requires some supervision because they play such an important role in economic functioning. Okay, so this is not a discussion of the importance of the banking system. This is sort of the importance of the central bank. So you still see my slides okay? Perfect, okay. So there are two important pieces of legislation that have shaped what it is our Fed does. And this is legislation after World War II. So when somebody says that the Fed doesn't have oversight, right? That there's no checks and balances on the Fed, that they can print currency whenever they want, and this is not really true, because there are really important laws that the Fed has to adhere to. The Fed was created by Congress. The Fed could be dissolved by Congress. So they only exist because of laws that have created and then given it powers. So the powers of the Fed, the most important thing for us is that the Fed has a dual mandate from Congress. And the dual mandate is not just, as most central banks, trying to keep prices stable in a country, but we also have the mandate from, this is from the Humphrey-Hawkins Act in 1978, of also trying to promote maximum employment. So the Fed in the US, our central bank has perhaps a more difficult challenge, because the Fed is required by law to not only take into consideration what's happening to prices and inflation, but also what's happening to employment. And those are sometimes, we've learned about, sometimes in conflict. How many people know what the Phillips curve is? Can you guys raise your hand in your screen if you know what the Phillips curve is? I have at least one person that tells me she knows what the Phillips curve is. Anybody else? How many other hands do we have? All right. So you don't need to know what the Phillips curve is, although probably we'll talk a little bit about it. But the Phillips curve is just a trade. It represents a trade-off between unemployment and inflation. We'll talk maybe a bit about that when we look at some data. But we're experiencing this right now, and we'll kind of talk about that tension, that problem, particularly for the Fed, who has to be concerned with both inflation and employment. So I'm going to skip over this slide. This sounds very much like the original reason it was created. But I will tell you that when the Fed was created in 1913, there was no such thing as monetary policy. It wasn't until after after the Great Depression in the US, when we had a lot of banks fail, we had unemployment of 25%, we had massive deflation during the Great Depression, and some people might know the name of John Maynard Keynes. And Keynes was a British economist who wrote about this time. From Great Britain. Great Britain was in a very serious recession. The US was in depression. And Keynes wrote about the possibility of using policy. He thought about fiscal policy, about government spending and taxing policies. But this has been now extended to the Fed. And now monetary policy is also introduced with the help of Keynes originally to be used in times of crisis, to be used in difficult times. And now we come to take it as usual that monetary policy should be something that is done, should be something that is used to help an economy when an economy is in trouble. So that's the only addition really to this list of Federal Reserve duties today, is now not in 1913, but as of sometime after World War II, monetary policy became a very important thing that the Fed does. So here is a map of the US, and you can see those, all the black dots represent, and the colored areas represent Federal Reserve districts in the United States. So you can tell that the districts are not divided up by land area, right? Because you can see how big the San Francisco district is compared to, say, the district number 3, which is the Philadelphia district, or my district is District 1 in the Boston area. You can see that up in the Northeast, we have smaller districts. We also have more population. So this is more apt to reflect population density, and also a varying different types of people and industry that work in those regions. So the regions were a long time ago created. So they were created in 1913 when the Federal Reserve was first created. And each region is supposed to have some farm area in it, some industrial and big city areas in it, but also is divided up by population density. So it's supposed to be, each district has to reflect a variety of different types of work and economic activity in the district. So, and these district lines have never changed. So these are the same, this has not ever been adjusted. Sometimes our voting district lines change, but our Federal Reserve district lines have not changed. So this is also a complicated scheme. I will not go through most of this, but for your own information, I thought you could get on one slide this idea of what the Federal Reserve structure looks like. It's much more complicated, right, in the US than it is in Ukraine, the structure of the central banking system. And that's just because we're quite a big physically quite a big country. And we have, like I said, those 12 districts that have to be managed. This scheme is the sort of the one of the middle smaller boxes, which represents the Federal Open Market Committee, because the Federal Open Market Committee is the group, so it's here in the middle, is the group of people that set monetary policy, and they meet every 6 weeks. And it is made up of the voting members of the Federal Open Market Committee are made up by the Board of Governors, and the people that are serving on the Board of Governors are appointed. So this is important from how separate the central bank is from our government. It's important to note that the people who serve as governors at the Fed are appointed by the president and confirmed by the Senate. So these are presidential appointees. None of these people are elected officials. They are not, this is not democratically done, if you will. So the 7 members, so they have the majority on the Federal Open Market Committee. The Federal Open Market Committee are 12 members. The majority are appointed by the government. The other 5 members of the Federal Open Market Committee are 5 presidents from those 12 district banks I was mentioning. And those presidents are elected by the member banks, by the banks that belong in the district. So there is some more selection, some more local information that's used to choose the district bank presidents. And they all have a role to play in determining monetary policy. And those presidents rotate. So it's not the same president every year that gets to have a vote on monetary policy. So just for your own information, sort of a little bit about the structure of the Fed. It's very different in the US. So I mentioned a little bit about the separation of our central bank from the government. And I've said 2 things to you already. One is that 7 out of the 12 voting members of our Monetary Policy Committee, our Federal Open Market Committee, 7 of the 12 are appointed by the government. So that's not entirely independent, right? That does depend on who the president is. It turns out that President Donald Trump, when had the opportunity, he appointed several people that are now serving as governors. And I'm not sure if Biden's actually had to had an opportunity to appoint anybody. That there's a way in which this happens. Not every president gets to appoint members. It depends on the rotation. At the same time, we have those more independently chosen bank presidents, and we also have the law that the Fed has to agree to. So the Fed's goal isn't to do what the president wants. The Fed's goal is to stabilize prices and promote maximum employment. So sometimes what a president might want the Fed to do might not be in line with the laws that the Fed has to adhere to. So this slide just summarizes some of the ways in which the Fed has been structured to keep it separate from politics, separate from the government as much as possible. So the Fed structure, we have this board of governors, and those members of the board of governors serve long terms, but the chairman only serves 4 years. So that's Jerome Powell. And Jerome Powell, each president that comes around has an opportunity to change the chair, to change that person. If the president wants to, the president can change the chair of the Fed. Every president that's elected has that opportunity. So I also mentioned, I should mention that elected officials and members of the government's administration can't serve on the board of governors. So if you're an elected official, if you serve in the government, you can't work at the Fed. And also, most importantly, the Fed is not funded. So our central bank is not funded by our government. Our central bank, does anybody have any idea? So I have it here. Our central bank holds a lot of securities, things like government bonds and other types of government and shorter term bills. So our central bank is restricted in terms of the types of assets that it's allowed to buy. It is allowed to buy U.S. government savings bonds. And so it actually makes a lot of money by these holdings. And so the Fed itself is independently financed. It doesn't need our government to give it money. In fact, often the Fed makes money, so earns extra money from its security holdings, and anything that is extra has to be returned back to the government. So it uses its own funding to pay the board of governors, to pay for its staff, to maintain its buildings. So it's independent, it's financially independent from the government. Does that make sense, I hope, to everybody? That's an important part of the Fed. And I don't know the answer to how the National Bank of Ukraine is funded. It may be, it does have its own independent holdings. So it probably, to a degree, is self-funded. So here's our Federal Open Market Committee, our Monetary Policy Committee. That's what you call your Monetary Policy Committee. We call it the Federal Open Market Committee. And that's what the boardroom looks like. That's where they meet. I've been there once. And you know why we're interested in the Fed, of course. They conduct monetary policy. They affect the volume of credit, money, and interest rates in the economy. Notice I don't put exchange rates there, and that's going to be a big difference between my discussion of what the Fed does in the US and what you think about regularly when you think about monetary policy and because in the case of Ukraine, an open economy where exports and imports play a much larger role in your overall economic growth and in GDP, exchange rates are very, very important to you. Whereas as in the United States, with the dollar being such a strong international safe currency, if you will, we worry less about exchange rates. We're more insulated from exchange rate fluctuations that are unconventional. Maybe these are no longer unconventional tools, but this is the language we still use. So how many people have heard the phrases quantitative easing or quantitative tightening? Do you recognize those terms? Okay, I've got at least a will. Thank you. I figured you would know those phrases. So a couple of years ago, I never would have talked about quantitative tightening, right? Because we were only easing. We were only still trying to recover from both COVID more recently, and the financial crisis a little while ago. But now, of course, today, with inflation around, we're talking about quantitative tightening. So these are thought of to be unconventional tools. I will tell you that there was a country that had been using quantitative easing as a tool of monetary policy long before the US adopted this policy. Anybody know what country that is? So we had global experience with quantitative easing. The US never did it. Never engaged in quantitative easing before 2008. But there was another country for sure that did. So luckily we had somebody who had some experience. We could learn from what they did. Anybody know what country I'm talking about? No guesses. We've no brave souls.
No, Japan.
Yeah, it was Japan. Yeah, Japan. So think about, if we know a little bit about poor Japan, Japan is used as an example of what to avoid. And they were in a recession, or very, very slow. They continue to be in this place of very, very slow growth, no inflation whatsoever. So prices sometimes deflating, not inflating. And that's been true since the 90s. So they call this period of the 1990s and first decade the lost decades. And they've been doing everything they possibly can from a policy perspective. They just can't get two things that's happening in Japan, right? Is consumers don't like to spend. It's not part of who they are. Culturally, they're savers. But also, more importantly, their population is aging. And those two things are not exclusive, right? As you get older, you tend also not to consume very much. You consume less as you get older. So they've really been hit with a couple of demographic problems, as well as some cultural issues, where it's been a very difficult problem to solve in Japan. So quantitative easing, luckily we had some other, I don't think luckily is not the right word, but we did have experience with quantitative easing before. And forward guidance is a communications tool where the Fed can try to, that key policy tool is now, okay, interest rates are zero. And the US will not, we do not, my understanding in the US is there are legal issues surrounding negative interest rates. So maybe you've heard of negative interest rates, right? The ECB, there are countries in the Eurozone, and the ECB has used negative nominal interest rates before as a policy. We have decided, I think I think there is some question about the legality of doing that in the United States. So we've not ever decided to use that as a tool. So instead, we've used these unconventional tools when we're at the zero lower bound. And forward guidance is using language to try to steer the economy in the direction that the Fed wants it to. And language is really important today, I think, too. So we'll talk a little bit more about that. Okay, very quickly, these are the tools that we use to steer the federal funds rate, to target the federal funds rate. This is kind of a technical discussion, so I think I'm going to skip over this. And if you have questions about this later, you can feel free to ask me how it is the Fed actually changes the target rate for our key policy rate. But these are today's rates, the ones that are on the right-hand side there. Most importantly, the federal funds rate, the one at the bottom right corner. This is the interest rate that the Fed targets And then this is the interest rate that then provides a floor. It provides a lever or an anchor, really, to all of the other interest rates that a consumer or a business might have to consider in their decision making. So I wanted to show you, because this is something that I don't know if students there think about the interest rates that are relevant. So the federal funds rate is not an interest rate that I can earn on my bank account. It's not an interest rate that I can pay if I borrow money. That's the interest rate that banks borrow and lend to one another. That's the one the Fed controls, borrowing and lending bank reserves to one another. But that interest rate, of course, is tied to all of the other relevant interest rates that businesses and consumers care about. So I wanted to show you a little bit of data about the interest rates that I would care about as a household or a consumer. So what I've put here, the dotted line, the one that's kind of high, this is the finance rate on installments at commercial banks for car loan, for borrowing money to buy a car. That's pretty standard in the United States. Lots of people borrow money to buy a new car. So you have to get credit for that. Maybe less common in Ukraine, definitely common in the United States to take out a loan for a car. So you can see that when interest rates are zero, and I went back just to the financial crisis in the data series that you see, but when interest rates are zero, which we had basically set them, so the set interest rate is going to be those two lines that you see, the Treasury bill rate, the green line, and the federal funds rate, the blue line. So that's the federal funds rate is controlled by the Fed through open market operations. And then the green line is very, very much tied to what the Fed does. The very short-term Treasury bill rate in the US, those two are very closely tied to one another. And you can see that when those rates go to zero, then the cost associated with borrowing for a home, which is the red line, that's a 30-year fixed mortgage rate. So these are very relevant to somebody like me. I bought a house in May. So I was very lucky. I bought my house just before interest rates really started to significantly rise. I did know a little bit about economics before I timed that fairly well. So hopefully this is worth your real world while as well. And then you can see about car loans. Does anybody have any questions about these interest rates? This is what I do when I teach this in the United States. I want students to understand the Fed's key policy rate isn't something that's relevant to me or to them. But of course, changing the key policy rate will affect the interest rates that I have to pay or I earn potentially. These are not earnings, these are bank earnings rates. Anybody have any questions about lending in the US? These are the two most important rates. Of course, we have credit card rates. Those are even higher, right? Even higher than all of these. Those are maybe the other important. Oh, student loans. In the US, students have to take out lots of loans to fund their education. And student loan rates will be similar to the rates you see here, because often student loans have maybe 10 years to pay those back. So they're longer term and they're fairly low. And they can be subsidized also by the government. So they're similar to these rates that you see here. Anybody, any questions about these rates and how they work? Or just thinking about how people make decisions regarding these rates? Okay. All right. So here's the Fed's balance sheet. The Fed's balance sheet is the blue. So this is quantitative easing at work, if you will. You can see that the balance sheet was not something that anybody really cared about. I do have Japan. And you can also see here how I wish I'm not in Fred, so I can't play with this data to show you the magnitudes of these things. But you can see the scale on the left-hand side. These are in trillions, because there's lots of zeros, trillions of US dollars today. And so if you and I were doing this lesson 10 years ago, I remember I remember 10 years ago, that the bank's balance sheets were only globally, the highest balance sheet 10 years ago was only about $3 trillion. And look at what's happened since COVID. Since COVID, and we thought that that was a lot. We were very nervous in 2012 to think about how big the asset side of these balance sheets, how much money, how much the value of these assets were being held at the Fed, all of these securities. The Fed was buying up all of these government bonds, and in our case, mortgage-backed securities that were federally, were guaranteed by the government. The bank, the ECB, the European Central Bank, can buy different assets. In the US, we have a lot of restrictions on the types of assets that our Fed can hold. I think the ECB is allowed to buy corporate and municipal, we're allowed to buy municipal bonds. I think that the ECB is allowed to buy government, individual country bonds, as well as corporate bonds. We're not allowed, largely we're not allowed to do that. We can buy municipal city bonds, but city bond, we have municipal bonds, treasury securities, government bond, US government bonds, and mortgage-backed securities. Our mortgage-backed securities are guaranteed by a federal agency, and that's it. Those are the only assets that we're allowed to hold. So there's not a lot of risk involved in the assets that our banks hold, but you can see how just dramatically they've grown. And you can see in each country, right, you've seen that the balance sheets are falling. That's quantitative easing, or quantitative tightening, sorry. That's quantitative tightening. We had no history of that. Little bit of quantitative tightening now happening in these inflationary times, but no signs of, some of this was natural. Now we're actually tightening. Questions about the balance sheet. So this is showing you that unconventional tool of monetary policy. And I want to talk just a little bit about the communication strategy. So it used to be that our Federal Reserve was very secretive. Prior to the financial crisis, the Fed met a couple times a year. They barely had speeches. They were very quiet. They held their information very close to themselves. They didn't share. So the public was guessing a lot of the time about what they were doing. And since Ben Bernanke is a very well-known economist who was the head of the, had a very difficult job to be the chair of the Federal Reserve during the financial crisis. And he decided that it was very important for the Fed to be more transparent about what they were doing. So they've adjusted their communication strategies pretty significantly. Now, actually, there's even more changes, but the most important thing is that the chairman of the Fed does a press conference after every meeting. So it used to be only 4 times a year. Now it's after every meeting. And they've published more material about not only what they're doing each meeting, but they also publish something called, this is the bottom right-hand corner, something called the longer run goals and monetary policy strategy. So even the Fed is even trying to guide the economy in the future, of course, because whatever's happened in the past isn't useful. Being backward looking doesn't help us to understand how policy today is going to affect the economy, because of course it takes time, right? There are a lot monetary policy lags. So they even have published statements about what their longer run goals are. And part of their longer run goal is to anchor inflation. And they've now adopted something called average inflation targeting, which doesn't mean that, which means specifically, we have a 2% target. What is the, do you know what the stated target is at NBU for inflation? Let's see if we can compare it. What is it?
Yeah, it's 5%.
5%. And do they have a range that they accept?
Yes, plus minus 1%.
Plus or minus 1%. Right. So technically that is average inflation targeting because they're saying plus or minus 1%. The US up until, so between 2012 and 2020, so really only fairly recently, the US had a 2% target, and they didn't say the plus or minus. They said 2%. And what the Fed discovered over time was that the public, financial markets, etc., the public believed that that was a ceiling. That 2% must mean, because the Fed was stating 2% must mean inflation can go no higher than 2%, because this is what we were seeing in the data. And then the Fed said, that's not what we mean. We mean more about what NBU is doing, which is to say 2% is our longer run goal. So they actually made a clear statement to say it's our longer run goal, but we want inflation to average 2% over time. And so that's been, and we've only targeted inflation not much longer than NBU, right? Not much longer than the National Bank of Ukraine. It's been, we have not had that official target for a very long time. And that was part of our strategy, part of the Fed's strategy. So I give you some other examples of forward guidance. So you can look in the policy statements of NBU and look at the language that they use to help guide people to not only make better decisions, but also to understand what it is the Fed is thinking. So for example, in 2015, so you can see in March of 2015, this is in their policy statement that they published after their meeting. It says the committee judges that an increase in the target range. So this is still when interest rates were 0. We hadn't raised them yet. So it was still after the financial crisis, hadn't raised them, but we're getting the economy ready to raise interest rates. The committee judges that an increase in the target range for the federal funds rate remains unlikely at the next meeting. They even said it, unlikely at the April FOMC meeting. This change in forward guidance, so they state this, does not indicate that the committee has decided on a timing of the initial increase in the target range. So you can see that even they can use language very carefully to try to tell people what's coming and what's not coming, what's for sure and what we know and what we don't know. Because they can be. You'll see this is a challenge. Maybe you've seen this. I don't know how you feel about NBU communications, but I have a funny slide at the end today that I'll share with you about forward guidance and the Bank of Australia. We'll come to that in a couple minutes. Natalia, how are we doing with time? I don't know when students need a break.
Okay, like we usually have like in 10 minutes, we have like a break for 10 minutes if it's okay. And again, I see there is like,
of course,
they are limiting our meeting. I have wrote to the technical support twice, like to stop this, but I don't know, like for now, it's still like we have limit. I don't know why. Yeah.
Okay, so, you know, if we, just to the students as well as to you, Natalia, if we get cut off or we have to stop early, I'm also, if everybody has time and is interested in coming back, we can finish it at another time. I will be flexible. Whatever you need from me, I'm happy to do it. I'll keep going for a little bit longer and then we'll take please, yeah, just let me know. I can keep talking, but I also I know the students need a break, and maybe during the break they'll have some questions. They won't want to interrupt me. We'll see. So I'm reminding you here of the dual mandate because it's going to come back to us when we talk about the pressure that the central banks are facing today trying to control inflation, and this is global, right? Every bank, every country is experiencing not necessarily unprecedented inflation, I understand, but all of us are suffering from inflation today. And it is unusual for the US. We haven't experienced significant inflation in a long time. Of course, it's not unusual for Ukraine, and we'll look at the difference. We'll also think about how, if you're used to dealing with inflation, how this might affect decision making. Whereas in the US, we're not used to thinking about inflation. So it's a challenge, and there's new research looking at this. I think it's important for policymakers to understand this. So here's my little cartoon of the dual mandate, looking at both stable prices as well as full employment. And we know, does everybody know the guy in the middle there? Have you heard of Milton Friedman? A fun fact, well, two fun facts about Milton Friedman. So I'm not standing up. You can't see how tall I am, but I'm not very tall. And in fact, Milton Friedman was shorter than me. I never met him, but I have read a lot about him. And I think my understanding is he's quite a bit, he's even shorter than me, which is something. Also, the other fun fact about Milton Friedman is that he owned a house in the country in Vermont. And where Dartmouth is not very far away from where Milton Friedman's summer home was. And I've actually gotten to visit Milton Friedman's summer home a few times and take students there. So it's a place where you can go and do workshops. It's on the side of a hill, a very beautiful location. But in the middle of Vermont. So I've actually been to Milton Friedman's summer home. Friedman is very well known for studying money and understanding the relationship between money growth, particularly in inflation. And perhaps the most important thing that he's reminding us of, which we maybe knew, but I'm reminding you of where it came from, why it is we know this, that money over time is directly responsible for prices, right? The volume of money and the growth rate of money is responsible for the growth rate of prices over time in the long run. So that's what these two, particularly the left-hand side diagram, shows you. It's sort of proof over long periods of time, over long time periods of the quantity theory of money, this relationship between the volume of money as well as the rate of growth of prices. So we know that inflation over time is a monetary phenomenon. And this is why we gave central banks, governments gave all our central banks globally, the charge to stabilize prices. As well, make sure that you're being careful with how much money is in the economy. Be smart about deciding about money growth and how much money in the economy is floating around. That's the key policy tool. And this is a guaranteed long relationship. The short run relationship is more controversial. That's the Phillips curve relationship. The short run relationship between money and prices is not as direct as it is in the long run. And this is something that gives policymakers a hard time. So you can see the short run, looking year over year, there's relationship, but it's not as clear between money and prices. And of course, policy is conducted in the short run. So the Fed has to recognize that this relationship between the supply of money and prices is not one for one in the short run. And this is why they have to be very aware of how much to change interest rates and what kind of quantitative easing or tightening to undertake to steer the economy as best they can. All right, so here are the challenges to targeting inflation. And there are a couple of them, and this is true in any economy, right? How to measure it in the first place, how to determine the sources of inflation. Where is inflation coming from? And is this a type of inflation that monetary policy can try to slow down? How much to change interest rates? And in the case of NBU, what to do with the exchange rate? How to adjust the exchange rate in order to combat inflation or deflationary pressures? How to communicate effectively is a question. And for our Fed, how to prioritize right now inflationary pressures with the other goal, remember, that monetary policymakers have in the US of maximum employment. So before we're coming to a break in a minute, but I'm wondering if someone in the room has any idea of, I've been talking about this conflict, and you're going to see it in the data in a minute. And you probably have learned about this, but what's the trouble both in the US as well as in Ukraine with bringing down inflation? What are the costs that we know are true? So we're raising interest rates, right? Well, in NBU, the key policy rate, I think, is still at 25%. The Fed is going to probably raise interest rates the next meeting, but maybe not by 75 basis points. They're probably going to raise them again. Why is this so difficult? Why is this not easy? Even if you don't have a dual mandate, but particularly for the Fed with a dual mandate, what does this do? Why is this such a struggle for the Fed? What's the cost? Anybody know? Maria.
Yeah, I'll try to answer. To my mind, one of the biggest issues with which policymakers come across when they decide to define the level of key policy rates, it's its impact on the output, GDP. If, for example, when we increase our key policy rate, it means that we actually want our households and firms to to save more than to invest. So it means that it leads to the to changes in our consumption, and as a result, the production level is going down a little bit.
You're right. That's exactly right. And so when production goes down, what happens to employment?
It decreases.
Yeah, it decreases, right? This is one, I always say this to my macro students. I say, this is the one relationship we're sure about in macro, right? If GDP is going to fall,